Neeraj Gambhir, MD and co-head of Fixed Income India at Nomura Capital India, joins us right now on the show. Neeraj, good having you. Thanks so much for joining in. What's the sense, Neeraj, on the currency? Because the reason it becomes so important today is that never as before, the view is split right down the middle. There are tons of people who are coming in saying that they still believe that the little bit of appreciation that we saw is short-lived and we are headed back to 58, 59 or different levels. And there are equal number of people saying that, hey, the worst seems to be over. Which camp are you on?
Well, I think I'm a little bit more biased towards appreciation because I feel that a lot of the fundamental factors which are driving the currency down have corrected or are in the process of getting corrected. Two major items. One is oil. I think the prices are substantially down globally. Second, gold imports. We are seeing a downward trend in gold imports. So I think those are the two biggest things which are having a drag on balance of payments. And if I see it from a balance of payments perspective, then we certainly see that the current account deficit, which was at about 4.5% last year, would probably narrow down to about 3.5%. And the capital flows are the most important driver in this context, and we have seen some resumption of capital flows in the last few weeks. So that's the positive sign. I think the key issue with rupee is that in the short run you could have a lot of volatility in rupee driven by the global sentiment and global factors, and in a slightly more medium term, I think eventually rupee will respond to the fundamental factors as well as the overall balance of payment situation. So from a day-to-day sort of forecast perspective, I think it looks like that you need to keep an eye on the global sort of risk sentiment. The other aspect of currency right now is that it seems to be a bit too volatile. On the day when it is a sort of a positive bias, you see a large outsized move down, and on the day there is a negativity in the market, you see again a fairly substantial depreciation. So those are the key things, and I otherwise feel that we should be sort of somewhere around 55 to 56 as the fair level on rupee, and maybe some appreciation bias.
Sure, Neeraj, but what would you say is the biggest factor which is weighing down on the rupee? Because you did mention the global scenario. You've got the current account deficit, which is high. The capital flows are fairly erratic. Which would you say would be the biggest concern?
Well, I think we need to make certain assumptions when thinking about rupee going forward. I mean, one of our key assumptions is that the oil prices will stay in about $90 or somewhat softer in and around that range. The second assumption that we are probably making is that the gold imports that we've seen a substantial run-up in the last year would probably see some softening bias given the fact that gold prices have gone up and gold is not really rallying that much. So if we start with these two assumptions, then I think the biggest driver, given the fact that we'll still be a current account deficit country to the extent of about 3 to 3.5%, will be the extent of capital flows. And I think that's what the market is going to watch out for. We have seen some sort of a resumption on capital flows both in equities and debt, and if that continues, I think that's going to be the biggest positive contributing factor. On the other hand, if the global risk of sentiment continues or there is a large tail event that happens and which then starts impacting the capital flows significantly, then I think rupee will be under pressure. So I would think that the biggest driver, assuming that the other two factors are in place, would be capital flows.
For the bond markets too, Neeraj, it's been fairly disappointing given that the RBI has not announced bond purchases via the open market operations for the past 2 weeks, the weak US jobs data too. So how do you believe the bond yields will read into all of this?
Well, I think the biggest positive news item for bond market last week was the announcement or the statement by the governor that they will resume OMOs. So market is hopeful that there will be a resumption of OMOs, and that is why you've seen some bidding interest in the bonds. I think everybody knows that the supply in bond market is heavy, so clear deciding factor would be how much and at what points in time RBI ends up buying bonds and the OMO announcements and the nature of bonds that go into the OMOs. I think from a supply standpoint, there is a risk that we will see fiscal overshoot or deficit overshoot, and hence the supply will be higher than what is currently being put out there. I do feel that the fact that globally the yields are headed down and in India probably the yield curve has been held where it has been held because of the inflation situation. I think over a period of time, again, if the global risk of sentiment continues, then the pressure would be on the yields to sort of stay softer, subject to RBI continuing with its OMO operations to manage the overall supply situation and the liquidity situation. We also have to keep a close eye on the liquidity. In the month of July, we have seen liquidity swing to more easier position. I think both the export credit refinance as well as the government spending have helped the liquidity come back into more normal situation.
Thanks very much.
Under the current circumstances, Reserve Bank.
Right.
Please make your point, Neeraj.
Yeah, I was just saying that if under the current circumstances, if RBI persists with the OMOs, the liquidity will swing into positive, and that will be bond positive as well.
Right, we'll wait and see if that happens, Neeraj. But for now, thanks so much for taking the time out and joining us for that quick perspective.